I've never found a technician who's been successful in calling market tops consistently. And I found a technician who's been successful in calling market bottoms consistently, at least based on his data. And that's myself. This is a very bullish pattern where the market spends a couple of months below an all-time high, and then when it breaks to the all-time high, it breaks in an upside gap, which means there's a lot of underlying buying pressure. Most likely that is bullish. I'd say 80% of the time it follows through to an upside market.
I am joined once again by Milton Berg of MB Advisors and Milton Berg Edge. Milton is one of the greatest market technicians alive, and he focuses on a lot of things that most technical analysts don't follow. So he's mostly not looking at charts. He's looking at data. He's looking at turning points. Milton, it's great to see you again. Welcome back to Monetary Matters.
Thank you, Jack. Nice to be back. We had a nice meeting last time, February 5th, right after gold peaked. And now we have a good meeting because it looks like stocks may have bottomed. At least the semiconductors and the KOSPI may have bottomed after really sharp declines. Let's see.
Yep, you had a great call when you identified the top in gold and silver. I believe you actually sold your personal precious metals the day
before the high. Actually, the day of the high.
Yeah. Day of the high. Yeah. So, Milton, I know you got a lot of buy signals in early April. We will get into that. Over 30 buy signals with median projections of between 8,000 and over 10,000 on the S&P. We will get into that in a moment, Milton. But first, where do things stand right now? Tell us about the panic low you saw in July 29th, the potential bull readings you see right now, potential readings you see now, and to what degree you're confident, and why in your various portfolios and model portfolios you are positioned the way you are. So what's your positioning right now and why?
Okay, well, currently we're positioned 100% long. This is our positioning. EWY is a KOSPI index. We're positioned 5% long KOSPI. Korea, right? We're positioned nearly 10% long the Russell 2000, 5% long the S&P mid caps, 10% long the Nasdaq 100, 20% long the stocks, and nearly 50% long the S&P 500 through the SPY. I'm pointing out we just positioned long on July 29th and 30th because we were short until then. So we actually covered our shorts the day of the low, the day after the low, and went long. So that's really our position currently. It's really diversified. Mainly, in the stocks is an index that lost some over 20%. We'll get to that in a minute. And KOSPI, of course, is down nearly 40%. So we really got into the losers thinking that they were way oversold. There was some panic selling and they should at least have a short-term bounce, if not more. Anyway, that was our position. But basically, we're bullish the market now. We're long the market with some caveats, with some very, very important caveats. I can start with the S&P 500 if you'd like.
Mm-hmm.
And the S&P 500 basically peaked in late May. It made a minor new high in June on a closing basis. But it collapsed about down 4.5% to June 9th, just a couple of days after its peak, and never made a lower low. The low in July 29th was a positive divergence against the low in, I think it was June 9th. July 29th low was above the low in June. So that's what's called a positive divergence. The market, although people were panicking, selling out of the semiconductor stocks, the Nasdaq 100 was making new lows, and the Philadelphia Semiconductor Index was making new lows. But the S&P did not make a new low, which is a positive divergence, which a technician would say that's just a sign that the market should be headed higher. So that's one positive sign. I use the term Montgomery date. Every time I mention cycle dates, I know people comment on your site, oh, what's he talking about? I shut this off as soon as I heard about cycle dates. I want to point out that we have some of the most sophisticated money managers in the world as clients. And they're very, very happy that we talk about cycle dates, because cycle dates is something that other people don't look at. People talk about seasonality. Seasonality is also something which really doesn't make any rational sense. But the cycle dates often work very, very well in pinpointing market turning points. Earlier in the year, if I can show you here, we listed what our cycle dates. As you can see, we had a cycle date on January 30th, which was the day that gold collapsed, you see. And we had a cycle date on right here on July 29th, July 29th, 2026 cycle date. That was the center of the date. The point is that cycle dates help us out in pinpointing turning points. So the reality is that the S&P bottomed on July 29th, made a nice spike low, turned right up, made a new high on a closing basis on Friday. And today it's down a bit. But it basically, the market was bullish off the July 29th high, low, and we're long. Looking at the technical analysis over here, I point out that there's another cycle period right now. You see? This square here, or this half square, is telling you that the next 4 days are possible. It's possible to see another turning point where the market might peak. Now, what's the logical reason? Why would there be a turning point if the market just bottomed? The reason is because maybe the market is making a broad top here. The reality is, although the S&P is at a new high on Friday's close, you look at other indices like the Nasdaq 100. Nasdaq 100 is below its low of early in the year, below its low of June 2nd. Nasdaq at its high, it's 3.02% below its high. It's currently 3.02% below the high it made on June 2nd. And you take another index like the Philadelphia Semiconductor Index as well, and that at Friday's close was 15.57% below its peak on June 22nd. So the point I'm trying to make is, although we were bullish on the market, and although we're thinking the market rally, it's possible all we saw in July was a short-term low with a sharp rally. You had the 5-day rate of change was the greatest in over a year in two of the major indices. So you saw a very sharp rally lasting about maybe 6-7 days. But it's possible it's just a leg up with negative divergences. Negative divergences meaning the S&P is making a new high, the Russell made a new high, but many other broad indices are not making new highs. And it's possible we'll go back down to test the lows. Now, when we give you a historical example, now you realize we had a serious decline in two major indexes. We had a serious decline in the KOSPI. Korea index, right? The major Korea index declined 43.93% in 27 days. Bottomed again on July 29th, the Montgomery cycle date, which is a turning point date. And we had the Philadelphia Semiconductor Index also had a major decline. I mean, that was the leader, up over 100% from its lows in March to its peak in June. It declined 28.73% into the July 29th low. So I gave, historically, when you see a crash low, at least historically, these lows are tested. Markets generally don't crash and go straight up. Now, of course, there was an exception in the COVID situation when the market was down some 35% or so into its COVID low and made a V bottom and turned right up. That's generally not the case. I give two examples of what might happen now. And this is the 1987 crash low. You see, the market was down, S&P was down 45.94%, similar to the decline we had in the KOSPI. That was the low, but it ultimately tested the low, came within a percentage point of the low 2 months later. That's what happened at that particular crash low. Therefore, I'm suggesting that the KOSPI and the SOX may rally, may peak right around here and trade back down to the lows. It may peak right around here because, as I said, currently we're in a cyclic period which has called in the past the end of short sharp rallies after what you call a cyclical low. So basically, we're positioned 100% long. We're bullish. We're on the lookout for the possibility of a short-term top here, and we don't think the S&P would test the lows if we're in a bullish situation. But we think it's more than a random chance that the SOX index and the KOSPI index trade back down towards their lows sometime in the next month or two, and we're cautious about that. Now, again, we're 20% long the SOX, the Philadelphia Semiconductor Index, and we're 5% long the KOSPI. I wouldn't be long if I was sure it's going to test its lows. So we're really watching out to see whether there will be evidence of a turning point right here in the current market. There is equivocal evidence that the market's topping here. And that is because you see this gap in the Nasdaq. The NDX 100 gapped into 4 days after the low, it generated a gap. Now, a gap off a low is usually considered a breakaway gap, right? It's usually a positive gap. But I've seen in the past many instances where the market makes a spike low, rallies up, and this gap is actually exhaustive. It's a sign that people think the bull market is still intact or headed for a major up move, and hopefully the market turns down. So this gap, I say, is possibly exhaustive, possibly a negative sign. If it would be a positive sign, the market really should head straight up. This gap should have been followed by a straight up market, but in fact it's followed, as you can see, by a trading market. That's in the Nasdaq 100. And you see the same thing in the KOSPI index. You see, the KOSPI index had a major decline, a major reversal, and then it gapped up right here, and it gapped into its recovery high date, you see? So on a technical basis, when you see a gap into recovery high, unless it follows through immediately to the upside, it's called exhaustive. The logic of exhaustive is there are people out there who lost a lot of money, and the people out there who luckily were not in the market and they didn't lose money. They're saying, wow, the KOSPI is down for nearly 44%, let me get in. And they get in a panic because they don't want to miss the move, you see? And that shows up in gaps. So that's another reason to think that we're going to test the lows. Or that's the best case scenario is the gap's telling you going to test the lows. The worst case scenario is that this is just a first leg in a bear market and the market is going to be headed lower. I don't think that's the case at this point. I don't have evidence for that, but of course that is a possibility. So anyway, in summary, the S&P made a nice low, positive divergence. It's rallying. We're long the S&P. We're going to look out this week, see whether it's going to make a short-term top. We show the fact that the net selling in equities by the retail people was greatest since 2022, which is a positive for the market, especially if the conditions are bullish. The background conditions are bullish. We showed that the semiconductor index had a major crash, down 28.73% in a short period of time. It's a recovery rally, but you see the gap. You had a gap right here, and you have a possible cyclic top. So we're on the lookout for the possibility of a short-term top, but we're still long. Nasdaq 100, same situation. You had a panic low, big rally, a gap which looks exhausted because it didn't follow through to the upside, and same thing with the KOSPI. Big crash. Most likely, the crash is going to lead to a 3, 4, 5 month strong upside move. Most likely, it's also quite likely, quite probable that it's going to test its lows before that. But there's an outside chance this is the first leg up in the bear market. I have no evidence for that. I don't see anything within the economy or anything other than speculation in stocks. I see nothing in the economy that suggests at this point there's a reason to suspect that this is just a first leg down in the bear market. Unless we're headed for a major recession, major economic dislocation, I see no reason to think this wasn't just a normal crash, which will be followed by a multi-month rally. That's the most logical scenario as I see it. But we're on the lookout. As I pointed out, in 87, you had a similar crash, similar to the KOSPI. Market rallied sharply for a few days as the KOSPI did. Then it started churning and made a lower low. I think it was December 4th. It made a lower closing low, but not a lower intraday low. I told my clients on the institutional side, if the KOSPI tests the lows, it's quite possibly will make a new closing low, but should not make a new intraday low. If it makes a new intraday low, it's more likely that was just a leg up in a bear market that will continue. But we see no economic evidence to suggest that a 43% decline should lead to even greater decline over the short term. Very little reason to believe that. So that's about it for my current view. I'm not in long in gold and silver. I had been long. We got out, and the market has been rallying. But the same story. Since we're in a cyclic period, that rally may taper off this week. The gold, long term, we're still negative on gold and silver. We think at a major multi-year high back in January, based on the evidence we pointed at that time, which I may show you later on in this interview if we get to gold and silver.
So you like the fact that the S&P 500 held in well as the semiconductor index, as the Korean stock market, as the Nasdaq were declining. To you, that's bullish for the S&P 500. Let's talk about the eye of the storm, those three assets, the semi index, the Nasdaq, and the Korea, which I would argue, we're putting my fundamental hat on, they're very similar to the same trade, given that Korea is like 50% semiconductors or semiconductor adjacent, and semiconductors, obviously semiconductors, and Nasdaq are dominated by semiconductor and tech. So it really is the AI tech hardware trade. Why, for your institutional clients, were you short, in that June, June to July 29th, and why on that July 29th low did you subsequently cover your shorts and then go long on July 30th? And tell us about that signal that you saw in terms of panic liquidation, which we now know was a hedge fund liquidating all of its public longs and publicly traded holdings. Just tell us about that signal that you saw on July 29th, July 30th, July 29th. And I know you want to go back. We will go back, but just that's my question.
But it has to do, you asked me why we were short, so we really have to go back to our last conversation.
Sure. Okay.
The chart from when we last spoke on February 5th. I showed you we have an indicator, which doesn't always work, but when it works very, very well. It's called the VXN, deviation from trend indicator. And basically tells you there's panic buying in the VXN. VXN is the VIX for the Nasdaq 100. It's called the VXN. Okay, these signals occur when there's a sharp short-term decline in the VXN relative to a longer-term average. Now, it's when a longer-term average is not going to be. I promise you, it's not more than 3 weeks. Okay, we're not talking about the 1-year average, and we're talking something like 3 days over 14 days, or 4 days over 17 days, something like that. Anyway, we got a sell signal on December 11th, 2025. Now, what happens since December 11th, 2025? I'm going to bring the Nasdaq 100 right here. If I can bring it, do you see this my screen? The NDX back here, this is back here, you see? NDX peaked on October 29th, 2025, but really went nowhere for quite a number of months. NDX peaked on right here on October 30th, and by by this date of January 28th, it was down 0.027%, it looks like. So it went nowhere. Having said that, it got nowhere. We had a sell signal on December 11th for the market in general. So that was one of the background reasons we believe that the market should decline. In fact, looking at the Philadelphia Semiconductor Index, okay, here's a semiconductor index. You see, semiconductor also did nothing for that period. Basically, you see, it did nothing, and we're on a sell signal. It's one of the reasons we're negative. But more than that, you see this sign, this little exhaustive gap. Maybe I can make this a little bigger so you can see it.
Yeah.
See this. There were two gaps in a row in the SOX index, Philadelphia Semiconductor, right here into this peak.
Remind us what a gap is, Milton.
A gap is when the market opens up above the previous day's intraday high and stays above it all day, which is a very rare occurrence. It's certainly a very rare occurrence in the broad index. In other words, the market opens higher than its highest high of the prior day and holds it for the full day.
And so that's a positive gap. The negative gap is when it opens lower than the previous intraday.
It's not a positive gap. It's an upside gap or a downside gap. An upside gap is very often a negative gap. It's a sign of panic buying. People don't care about price. They don't care that we're buying an index at a price higher than it traded in the last day or last week or last month, which was the case here. They didn't care, and they bought it. And it basically gapped up. This case was exhaustive. So now you never know if a gap is going to be exhaustive. A gap can either be what you call impulsive, headed high, or exhaustive. When the gaps come after a long move, it's most likely to be exhaustive. When a gap comes after a decline, upside gaps after a decline is most likely to be impulsive. That's the rule, one of the rules. Now we have no hard and fast rules. We watch the market each day, and we determine based on other indicators whether it's likely this move is exhaustive or impulsive. Anyway, these gaps proved to be exhaustive. The SAX did not manage to get significantly higher than it did at the time of these gaps, and ultimately declined 16.64%. So the reason we were short really was things we spoke about last time, which was that we had a sell signal on the VIX, the VXN indicator. This is a history of the declines for the successful signals. The history of the declines, we were down 17, down 23, as you can see. In our instance, the SOX declined some 16% to its low in March. The SP declined some 8% or so to its low. So it wasn't the greatest signal, but the reality is that it was one of the reasons we remained short, combined with the chart patterns I showed you, combined the fact there were exhaustive gaps, combined the fact that the market got nowhere for a while. So and then on March 30th, which we'll get to later, as you said, from March 31st through the end of April, we had at least 20 buy signals, which got us long. And as you know, it was a historic rally, not necessarily a historic rally for the SP 500, though some people claimed it was, but certainly was a historic rally for the Philadelphia Semiconductor Index, which gained over 100%, or the S&P Technology Index, which gained over 90%. So really, it was a historic rally. So the sharp decline we saw into the lows of March 30th was a setup for the move we just had. And the question is that move over, or is that part of a bull market that we'll discuss a little later on? This is what I showed you last time. I showed you the gap. You see, this is a gap back in January in the Russell. This is a chart. I just copied it from our last interview, and I suggested this is bearish. Now, where did the Russell go from there? The Russell ultimately went. This is the gap I showed you. You see?
Yeah.
Ultimately declined a total of 12.07%. So that gap proved successful, even though when we spoke last time, all I was able to show you was a few days action, which is right here. You see? But ultimately, that gap proved to be an exhaustive gap. And it was an island reversal as well. These are all technical terms, but the reality is, the reason we were short was because the market gave indications of a top. We had no idea what, and I said at the time, it's quite possible, at any given day now, it's possible for the market to make a major long-term top. Everything that is necessary for the market to be at a long-term top is basically in place. You have overvaluation. You have in many measures, the so-called Buffett indicator of market cap to GDP, which has been overvalued for a decade, but it's more overvalued than ever in history. Or you look at margin debt, for example, relative to cash balances, it's highest in history. whether you look at how interest rates are acting with the long bond, even the short rates, they're rallying. It's quite possible the market top right here and we head for a multi-year bear market. It's quite possible, but we're not projecting that. If it happens, it wouldn't surprise me. But we're not fear mongers. I'd rather the market give me evidence that it's topping, and at that point, we'll decide to either go short or just get out of the market, get into treasury bills. But at this point, with the market making a new high on Friday, S&P, even though there are divergences, we want to see more evidence that the market's topping than strictly some divergences. As I said last time, I say it again. All these fear mongers out there are correct. It's quite possible that the market peaks today and crashes 50 to 80% over the next year. It's quite possible because the background is in place. However, the fact that the background is in place does not mean the bull market has ended, because the nature of a speculative bull market is that as much as overvalued as it is, and as much evidence as there is that the market's topping, it doesn't top until it tops, and that's been the case now. I'm saying this because every time I turn bearish, in the back of my mind, I say, I don't know if it's going to be a correction or a bear market. I have no idea. We got bearish when we see a turning point signal at the top, and we get bullish when we see a turning point signal at the bottom. But we really, when we see a top, we have no, especially in the current situation, we have no idea whether it's going to be just a corrective decline or a major bear market, because the background is definitely in place, and I'm not going to argue for a major bear market. Now, one thing that's not in place is usually you don't get a major bear market until the Federal Reserve tightens, and they haven't tightened yet. So we don't want to anticipate will the Fed tighten or not, but it's most likely that Kevin Walsh will tighten, and he most likely will do some quantitative tightening as well besides raising rates. But you don't have to anticipate it. Usually bear markets take place after the Fed moves. Bear markets anticipate the economy. Stock markets anticipate the economy, but they don't anticipate Federal Reserve moves. They wait for the Federal Reserve to make a move before the markets turn. So therefore, for that reason, it's likely that the market has not really peaked yet. At least the S&P 500, the high we saw on Friday, is most likely not the final peak, but it's possible that it is. So I don't know if I answered your question about what we're seeing now. So let me show you this. It's KOSPI. See, the KOSPI had an exhaustive downside gap 2 days before the low.
On July 29th, yeah.
2 days before July 29th. We told our clients we expect one more day of panic. We had one more day of panic, and that's where we got long. Because usually you don't see 1 day of panic. Usually it's 2 days of panic into a crash low, and that's what we saw. The type of low you saw when you have this major liquidation. Major margin liquidation. You have people in the United States who weren't necessarily liquidated on the margin, but selling because of what's happening in Korea. That's really a reason to go counter the market and to go long. And we really waited for the evidence at the low. Besides the Montgomery date, we saw the reversal. We went long on the reversal. So not a lot of sophisticated analysis here. Strictly market watching, analyzing markets, and keeping on top. This is a very important line. I didn't mention. You see this line across right here? This little dotted red line. This is the S&P 500. S&P 500 broke to a new all-time high. This is the line. This is the previous all-time high. This is the breakout, but it broke out on a gap, you see? Usually when you break out on a gap, it's an impulsive gap. Usually it's a sign that the market's headed much higher. Usually. And I'm going to give it, right now I said we're 50% long the S&P. We're giving it the benefit of the doubt. This is going to be an impulsive gap. But let's see what happens over the next few days where you have this... we have this Montgomery date, you have this turning point date. But, we're staying long towards the evidence that things are changing. But this is a very bullish pattern. This is a very bullish pattern where the market spends a couple of months below an all-time high. And then when it breaks to the all-time high, it breaks in an upside gap, which means there's a lot of underlying buying pressure. Most likely that is bullish. I'd say 80% of the time it follows through to an upside market. So that's based on chart patterns alone of why we're bullish here. Why we're bullish currently. Now it's also based on data, and I'll have to get to the data a little later. But this is what we see at this moment.
And Milton, one thing you've said to me is that everyone wants technical analysts, market technicians, to call market tops, but actually it's far easier to call market bottoms.
Yes.
So even though you made a bear call when we did our interview in early February, and that happened to be right on the Russell S&P, congratulations. But you actually have less confidence in bearish signals than you do in bullish signals. And actually, I think you've had some incredible calls over the interviews that I've had with you over the past 4 years. But I think some of them have been right after market panics on the bullish side. Right. And that is kind of where we're positioned right now.
Right. This is the story. The reason most technicians and most analysts are always trying to call a top is because they're worried about a top. Most investors are long the market. Let's face it. 99% of investment is long the market. You're lucky to see 1 or 2% short interest in a broad market. So throughout the world, the trillions of dollars, the S&P 500, people are invested long. By the fact they're invested long, they're worried. They're not worried the market's going to rally. All they're worried about is the market might decline. Now, they're really not worried about a minor decline of 5, 10, or 15%. They're really worried about a crash, 50, 60, 70, 40%, right? That's what they're worried about. And therefore, technicians and market analysts are always worried about that. And I say, I've learned over the years, I've been in this business for quite, more years than I can count. It's not necessary to anticipate a bear market. Wait till the market declines 4% or 5% or 6% or 8% or 9%, and get out then in anticipation the market may go down another 30%. You don't have to call the exact top. And not only do you don't have to call the exact top, it's very difficult to call the exact top because the nature of market tops are that they're generally the rolling tops. They're generally not V tops. They're not V tops. They're generally rolling tops where one index makes a high one month and another makes a high another month. And it's very difficult to call. I've never found a technician who's been successful in calling market tops consistently. And I found a technician who's been successful in calling market bottoms consistently, at least based on his data. And that's myself, because we've modeled every market low since 1957. And we have thousands of I can show it a little later. We have thousands. You can give me any date and I'll tell you what, show you our model for that date. We've modeled every market low. So I found for myself, it's much easier to call a market low. You don't have to call every market top. If you get it in at the lows and you get out 8 or 9% after the peak, you're going to do fine.
Stock markets don't make sharp tops. They make rounding tops, but commodities make sharp tops.
Commodities make oil. Commodities make. Well, one of the reasons commodities make sharp tops is because unlike the stock market, commodities trade in the futures market. They don't trade in a real exchange. For every short, there's a long. For every long, there's a short. Anytime you see a market rallying, and anytime you see commodity market rallying, you know that there's a lot of shorts on the other side of that trade. And those shorts are going to panic into a top and cause a spike top. In the stock market, it's the other way. People don't really panic when the market's rallying. The shorts may panic, but you don't see there's not enough shorts to cause the market to show panic evidence at the top. And then at the bottom, where trillions of dollars are long the market, that's when people feel they have to sell, even though they're told by their advisors that over the long term markets always rally, which is not really true. But they're told the long term markets always rally. People still panic when their portfolio is down 20% to 30 or 40 or 50%, depending on the person's constitution. So therefore, you see panic lows in the stock market. You don't see panic. Now, we see panic tops because we're looking at very subtle information. We're looking at, for example, exhaustive gaps that take place at the top, or we look for negative divergences, which are very, very subtle, which most people can't see. At market bottoms, though, the evidence is not so subtle. It's really blatant and obvious, but people ignore it because they're afraid that the market's going to go low. KOSPI is a perfect example. KOSPI is down 43%, 45%. No, this is 87. KOSPI is down 43.93% in 27 days, and now everyone's afraid it's going to go lower. You should have been afraid it's going to go lower at the top. Now they're afraid it's going to go lower, afraid to get in. I say to myself, evidence is that it's bottom. Let's get in. And it's going to make a test of the low. Maybe we'll sit through the test. Most likely we'll get out early and buy, get it to test. And if it's the unlikely scenario that's going to immediately go down and make go down 50, 60, 70%, we'll be out because once the intraday low is violated, we know that we're wrong and we'll be out. But people always worry about declines after the decline. I remember the crash of '87. I was involved in the market. I worked at Oppenheimer at the time. Crash of '87. I called the crash very well. I managed a mutual fund that went into 90% cash at the top.
Very good.
There's another story. But I remember at the bottom, all my portfolio managers in the group who were bullish at the top, were bearish at the bottom. They're afraid to buy. And I said, buy. Now's the time to buy. But that's just the nature of this business. So yes, stock markets make V bottoms, spike bottoms. They make rounded tops. You see, but commodities are differently. See, even this in the KOSPI, it's a rounded top because you have a top here and a top here. Not much of a difference. You see. Well, let's look at the Nasdaq 100, the latest top. You see. A peak here, a slightly lower peak here, a slightly lower peak here, you see?
Yep.
But the bottom, on the other hand, most generally is a V. Sometimes you test it and come off with another V. Semiconductor, same story. You had a double island reversal. Very, very rare. I've never seen it before, actually, a double island. This is the June top. I point out to my clients, so island reversal right here in mid-June, and then in late June, a double island reversal right after the island reversal is it gaps up, then the market gaps down and creates a two spaces, which creates an island. Island reversal here. This is also, it's not a V top. This is really a rounding top, as you can see. The bottom looks more like a V bottom. We'll see whether that continues to the upside today. Right now, the semiconductors actually made a new high on Friday. I think semiconductors index generated a new intraday high on Friday, another slightly higher intraday high today, but now it's down in the day. But so it's doing fine. This gap might prove to be impulsive. We'll see. See what happens. Okay, that's the current market. I like to tell you why I'm bullish, and not strictly because of the cycle lows and the action we've seen off the lows. That's not the main reason I'm bullish. There are more important reasons that I'm bullish.
So we have to go back in time.
March to April. Let's go back to April. Really, right? Go back to April and
was when we got the buy signals. I counted actually. I think you got at least 34 buy signals in late March, early April. And they had median projections on the S&P 500 from 8,200 to over 10,000 on the S&P. So sorry to steal your thunder.
No, they're not going to steal the thunder because without evidence, without showing the data, anyone, you know how many people get up there, even on your show, and they project, oil's going to $500 or silver's going to $2,000 without really evidence. It's just fantasy. It's just fantasy. It's just a dream. It's a fantastic dream people have without evidence. So at least every time we make a projection, it's based on evidence. And we don't trade based on projections, but everything we do is really based on evidence. And let me get to that right now. So we're going to get to the why we're bullish. We got a buy signal on March 31st, which I ignored at the time. I'll tell you why in a minute. Then we got a signal on April 10th, April 13th, April 4th. We got multiple signals. April 14th, April 15th, April 16th, April 17th, April 20th, 22nd, and 27th. Let's take one at a time. It won't be complicated, just to show you what we saw. This signal was ignored because it only happened once before in history, and I don't use signals that only happened once before, even though it was a clear oversold market on March 31st. What happened at the time? The S&P 400 was down for 5 weeks in a row. And these are not calendar weeks. These we break up the market into 5-day segments. Each segment is called a week. So we had the S&P 400 was down 5-day segments in a row. Russell 2000 was down 5 weeks in a row. S&P 500 was down 5 weeks in a row. And then, right, and the OEX was up 3% for the day. In other words, right?
What's the OEX?
Oh, the S&P 100 index. The biggest, one of the largest stocks in the S&P was up 3% on that day. This is March 31st. This is March 31st, right?
Yep.
The S&P made a 4-day high, 1 day past the 4-day low, which is also a rare occurrence. Russell was up 3% of the day, March 31st. Nasdaq was up 3.5% of the day. S&P 400 was up 2.5% of the day. S&P 200 was up 500 was up 2.75% of the day. S&P advances over declines was greater than 4-1. S&P 400, the mid caps advance over declines was greater than 4-1. S&P 600 advance decline was greater than 4-1. Unfortunately, this only happened once in history at a major market low, which is right here at the COVID low. Let me show it to you. It only took place once before the COVID low. To have all these things happen at the same time, all these markets down 5 weeks in a row, and 1 day past that low, all these markets are 3% or so on, and strong AD line. We couldn't use an indicator, but that exact same thing happened right here on March 31st, 2026.
Yeah, so Milton, I mean, so you have people who do sports betting are familiar with the term parlay of I expect A to happen and B to happen and C to happen. You kind of have this 11 or 12 signals where all of these things were triggered at the same time, but this thing has only happened once. And it was on March 24th, 2020, which was
1 day after the COVID low.
One day after the low. I mean, Milton, if I get a call and it's you and you say, Jack, I've got a 12-leg signal. It's only been triggered once and it's been triggered on March 24th, 2020. Are you buying? Are you selling? Or are you holding? I'm saying I'm buying. I'm a buyer.
You know what? I have the discipline that I don't trade on the signal that only signaled once, even though logically you're right. And I always tell my clients, this is illogical, but it just protects me. In this case, it cost us 8%. We did lose 8%, but we didn't get a conventional buy signal until April 10th, which is 8 days off the low. This signal took place 1 day after the low. So I'm admitting my errors, call it an error, but in the future, if it happens again, it will be a buy signal. Now goes into my model, since it happened twice. But the point is, this projects to 8565.42 as a median projection within a year of the signal, which is another 10.42% above current levels. Okay, Let me get to the next one. We're going to go on.
Wait, Milton. Sorry, but I have it as it projects to 10,600.
Yes, you're right. Let me tell you why I'm doing this. And you asked a good question. I thought I could get it by you. Since it
Yeah,
only happened once before, there's no median, you see?
I
It
see.
happened
Okay.
once before, and let me get you the numbers. Boy, oh boy, here it is.
Yeah, the March 24th.
Happened once before, the market gained 62.39% within a year. However, within 60 days of the signal, the S&P gained 16%, which is exactly half of what it gained after the 2020 low. So I cut the projection in half to make it fair because I couldn't use the 62.39% here.
So technically, Milton, you had a signal that was ridiculously bullish on a sample size of 1, to be fair, but ridiculously bullish, and you made the non-systematic discretionary decision to say, actually, I'm going to tone it down. I'm going to tone the bullish.
I did it based on data. I did it based
Yeah.
6 days after the signal. It had a great move up 16%. That's phenomenal.
Yeah.
But it's half of what took place in 2020. So in order to be a little bit conservative, I'm using
conservative.
half the projection. That's only the only case. Every other instance had more than one signal. Here's the next signal. This signal takes place on April 10th. Okay, this is what got our clients long. We got long based on this signal. So in this case, very simple, reasonable, easy signal. Nasdaq 100 declined at least 12% and held its low for 8 days. So we're 8 days past the low. During those 8 days, the Nasdaq Composite was up in each of those days, 8 out of 8 days. Okay, two simple indicators. Nasdaq declined 12% and holds its low for 8 days, Nasdaq 100. And the Nasdaq Composite was up 8 out of 8 days. Very simple indicator, yet it's only happened 3 times in the past. And that projects the minimum would be to 7942.59, which is only 2.38% above current. The median of that's the actual minimum return. It's not the median of the minimum return, it's the actual minimum return in history. The median of the maximum return would take us up to 89.53, another 15% gain above Friday's close. Let me show you a little bit about this. You see, this is signaled on October 18th, 1985, September 14th, 1988, August 19th, 2024, and April 10th, 2026. And I showed that we're in line. You see, this little light gray line, and we're in line with historical returns. So there's no reason to doubt those signals. You see this little gray line, this is where we are now. So since we're in line with what happened in the past, no reason to doubt that will not continue. So that's another reason why we're bullish. Not just because what happened now in July. You see, the way we understand markets is markets make great bottoms and markets make great tops. What takes place in between is generally random. It's very difficult to analyze the market on a day-to-day basis. It's good to we analyze markets exceptionally well at turning points. But once you get to turning points, you know the market trend is high for half a year or a year or so, depending on history. So anyway, we're still in line. And as I say, the median return is 31.35%. And we're already, and that projects, as I said, to 89.53.99 or up 15% from here. That's on April 10th. Then we got another signal, as I said, on April 13th. Another very pretty simple signal, and that is S&P. It was 9 days off the low. S&P declined at least 9% and held its low for 9 days. S&P 500 generated a new 30-day high, which is quite interesting. That after a 9% decline, 9 days later, it had a new 30-day high. Nasdaq had its greatest 10-day rate of change in 180 days, and the S&P 500 10-day rate of change was above 8%. These four occurrences happened 4 times in the past, and the minimum gain you ever saw would take you to 82.42.83, which is another 6.25%. The median of all the maximum gains in the year takes another 12.27%. So this is another reason why we're bullish. Not necessarily bullish because of what happened at the bottom in July. We're bullish because of the bottom took place in March and the buy signals in April. And going through this, as you will see again, this is the 82, 84, 898 signal, the current signal. But the most important thing, we're in line with the previous signals. The market is not out of sync with what had taken place previously. So our assumption is, since it's in sync, you should get close to the median or at least to the minimum. The minimum return is here, and that's another signal. That's on April 13th. Then that's not the last signal. Then we get another signal on April 4th. Then we got many signals. I'm showing you one for each date. As you know, we got over 30 signals, but I'm showing you one for each date. This is another signal that took place on April 14th, which was 9 days after low. Russell was up 8 of the last 9 days. The Russell 2000's 10-day rate of change was the greatest in 1,260 days, which I think is 5 years. So the Russell 2000 off the March low had its greatest 10-day gain in 5 years. Isn't that fascinating?
Wow.
Even greater than what you saw off the April 2025 low, even greater than what took place off the COVID low. Pretty fascinating, right? So it's not only the stocks that had a record-breaking run off the lows, gaining 100% off the March lows. On a 10-day basis, the Russell had its greatest gain in 5 years off the lows of March 30th. And the S&P also had its greatest 10-day rate of change in 5 years. Not just the Russell, even the S&P 500. This is a great momentum. So this took place 4 times in the past, and this projects to a minimum. The minimum gain would take it to 88.2628, which is another 13% off Friday's close, and the median takes you up another 18%. Now, should we doubt this? Let's see where we stand today. Looking at the history right here, we're right in line. We actually were below it, but now we're back in line, you see? So in effect, if you would have asked me this at the July low, you say, well, this signal is no longer working. But now this surge took us back in line with historical returns. So I have to give it a benefit of the doubt. The signal worked 4 times in the past. It's an amazing signal, amazing momentum. Now, there's an argument, a logical argument that can be made that this is a false signal. Logical argument, and I don't believe in this logical argument, but people will make this argument, is when the market surges like this, it's a sign of an unhealthy market. If the market gained more than it's gained in 5 years, why is that healthy? That's not healthy. That means everyone's buying stocks. My answer is, first, the data tells me it's going higher. In the past, it never happened. And secondly, if everyone's buying stocks, that is a very bullish phenomenon. It's not a bearish phenomenon, unless you see evidence of a top. And we don't see evidence of a top, especially now the S&P is at a new all-time high. That's the signal that took place on April 14th. And the median gain, historically, has been 32.08%. Okay, now let's go to the next signal. This took place on April 15th. Again, one of the many signals. This is a cryptic. I don't give you the exact formula, but we're looking at, and Ned Davis Research has a multi-cap equal dollar weighted index. Okay, it's big caps, small caps, mid caps, all in one index, but they're equal weighted. They're not cap weighted. Okay, and what you do is you're looking for deviation from trend thrust. You're looking for, I'm not going to give it the days. Let's say 10 days over 30 days. Okay, in this case, it was 2.3 times above. The 10-day gain was 2.3 times above the 30-day gain in theory, right? That's a buy thrust. So that took place 11 days after the S&P declined at least 9%. Okay, it's simple. You see a deviation from trend upside thrust 11 days after a S&P declined 9%. Okay, simple indicator. And again, this projects to a minimum of 84.94, a median of 97.67, which tells me to be bullish. And the history again is, you see that here after a major bear market, but here it wasn't after a major bear market. This is August 8th, 94. It was a 15% decline in Nasdaq. It wasn't a major bear market at all. Now we declined some 11, 12%. And we saw it in 98, we saw it in 2009, and we just see it here. See right off these lows, the market has gained off that, and we're in line. We're in line with the history, because even this instance it gained 17%. We're above. See, so it's still in line. It's a good signal. And that's another reason we have to remain bearish at this time.
Bullish, you mean?
Bullish until we see evidence to change. Now then we get a number of signals. April 16th. April 16th was 12 days after low, and 12 days after low, the S&P gained 10% above its last 10% decline. So all it is. 12 days after a decline of 9%, the S&P is up 10%. Very simple. You see, people are looking for very complicated indicators. Yeah. And we've modeled every market bottom since 1957. We found you don't have to be a genius. You don't have to, actually, you just have to be logical, conservative, and find simple indications that take place at turning points. And that gives you an edge. We call our retail product MB Edge, Milton Berg Edge. That gives us the edge. So let's see what this told us. This basically tells us we'll either get to 79.70, which is only 2.75% above, or another 17%. And let's see.
Milton, in this two-part indicator of the S&P declined 9% and it bottomed for 12 days, and then it
gained 10% over its last low.
Gain 10% over if its last low. Those are like two principles I see at play. Number one, it was in a bear market correction, and it bottomed, and the low held, and then from that low, there was overwhelming market action to the bull.
This idea that a market holds a low for 12 days is very significant. It seems very simple. William O'Neill built the whole business on what he calls confirmation days. He counts 4 to 7 days off a low, and we built on that. We don't look at 4 days, we don't look at 7 days. We built indicators using 1 day, 2 day, 3 day, 4 day, 5 day, up to 25 days off lows. See what? Because we're looking for turning points. You see, so it's a key that the market held its low for 12 days, and the market gained 10% into a new high, into a new recovery high into this date. And looking at the history, not in just we're way in line. You see, we're basically in line with historical. So why should I doubt the idea that these signals remain valid? Follow. Let's go to the next one. This signal. This took place on April 20th. Okay, VIX was down 8 out of 9 days. Number one, which basically means the market was rallying, but VIX is down 8 of 9 days. The Russell. The rate of change of the 10-day rate of change of the Nasdaq was above 10%, and again, that same multi-cap deviation from trend thrust was 2.3 times greater. In other words, the short term was 2.3 times greater than the long term, which is a thrust. This took place 4 times in the past. This projects to a minimum of 8,600 and a medium of 9,400. You don't want to bore anybody, but I'm just trying to point out what we do is not based on moving averages. What we're doing is not based on anticipating where the price of oil is going to go, or doing it not anticipating whether the Fed will tighten or whether they won't tighten. Not that we don't look at the things everyone else looks at. We look at data, market-based data, and I'm an economist as well. I know very much about the economy, how to analyze monetary policy, but that's not what we trade based on. That just is the background of my head if I want to feel good about my views in the market. But really, we look at the data, and in this particular instance, as you'll see again, we're in line. We weren't in line going back until the June peak, but now we're back in line with history, and I'll assume that's going to continue. The next signal took place. This signal is on April 22nd. This only occurred twice in the past. The Russell, this is amazing. Okay, I don't look at moving averages with crossing. The Russell 2000 traded above its 5-day moving average for 16 days in a row. Okay, now interesting.
Wow.
The market only bottomed 16 days ago, which means at the day of the low, the Russell was above its 5-day moving average, which is kind of fascinating. On the day of the S&P low, the Russell was above its 5-day moving average. Anyway, the point is that the Russell was above its 5-day moving average 16 days in a row, and the Nasdaq declined at least 13% and held its low for 16 days. Get two simple things together. Projects to a minimum of 85.43 or a medium of 92.99. And let's look at the history. History is right here. It took place in September 7th, 82, March 7th, 2016, after just a minor corrective low. And right now, April 22nd, 2026. And we're in line. You see, we're in line with the history. So it's another bullish indicator. Now, of course, the further away you get from a low, the fewer signals we get. But I wouldn't say they're not as reliable. You're not going to get a 10-day upside thrust 3 days after a low. But you're going to get a 10-day upside thrust 9, 10, or 11 days after a low. So some signals, by definition, can't signal at a low. You have to have the market trade for 1, 2, or 3 weeks after the low until you get the buy signal. In any event, this is a signal on April 27th. Last signal we got 19 days after the Nasdaq's decline. The Nasdaq was up 16 of 19 days. Okay? Two interesting indicators. The Nasdaq made a decline of 10%, held it for 19 days. During those 19 days, the Nasdaq gained in 16 of those 19 days at least. This took place 3 times in the past. Let's see when they took place. Let's see what happened. It occurred right here. This is very good because it's very similar to our market. I say it's similar to our market because it didn't have a major bear. It didn't come after a major bear market. It came after a minor correction. You see, right here, November 4th, 1985. Okay, went straight up. Then you saw October 30th, 1986, also after minor correction, very similar to our case, you see, right here. And you saw it again November 22nd, 2023, also after minor corrections. This is very, very similar to our situation. And you saw it right here after minor correction, you see. And in this case, we're out of line with the history, unfortunately, you see. And this late signal, April 27th, we're not in line. So if all our signals would show this, I'd say they're not working. But since the vast majority of the signals, the market is acting properly after the vast majority of the signals we've seen, and that keeps us bullish. That's really
and most of these signals have very few false signals. Would that be correct?
No. In this instance, None of the signals have false signals.
Exactly. That's okay. Yeah, that's my point.
None of these signals. Now, you bring up a very good point, okay? Again, it took me 10 years to create these models, okay? And I couldn't manage money during the period because you can't manage money and spend time doing research at the same time. It's impossible. That's why the great hedge fund managers hire people to do research for them, because they can't do both. Even though, like, a guy like Stan Druckenmiller is great doing research, but he has to have people doing research for him because he's busy trading markets. Follow?
Mm-hmm. Yep.
So anyway, your question is good. When I built my models, I was very tolerant. If 80% of the time the market did well, it was good enough for me. But after going through so many indicators, I had thousands of indicators, I was able to cull them and eliminate all signals that didn't work perfectly. So I'd say more than 95% of my signals that I use are perfect signals with no real drawdowns. When I say no real drawdowns, there's a caveat to that. And this is a very important caveat, because let's say I'm going to go back to a previous chart to show you what I mean, okay? Let me show you here. You see 1987, right? October 1987, right? We got buy signals over 19th, October 20th. The market declined 12% back to its test of the low, but it held the original low. The signal is telling you that was a turning point. The signal is not necessarily going to tell you that the market won't pull back to test the low. So in some instances, we consider it a valid signal, even though the market pulls back because it held the low, and all the signal is telling you is that's a turning point, and that's it's a good time to be long the market. Now, we've adjusted for that. I don't make it complicated. For our institutional clients, we've made it a little more sophisticated, and we would get out after X% decline and then get back in at the low. But for the retail clients, if you got in on October 19th, 87, we basically ride it unless certain. I don't want to make it too complicated, but yeah, we're turning point analysis. If the turning point is there, the fluctuations post the turning point don't really matter so much. But most signals don't work this way. Most of the signals, as you'll see, are perfect signals. Let me go back to where we just looked at. Anyway, this is a combination of all my signals, not just the ones I showed you. These are all the signals starting on March 24th through April 27th. The median.
Go ahead.
April 27th. The minimum expected return is to take it to 82.8621 of the S&P, which is another 6.82%. The median of the maximum returns would take you up another 15.49% to 8958.23. Let's look at all our signals.
So Milton, I remember in 2023, the spring, we did an interview and you literally said bullish, right? And you said I challenged the bears, and obviously that bull call turned out tremendously well.
That signal took place after the October 2022 low.
Right. Yep. So Milton, what is your level of confidence right now relative to your level of confidence when we did that interview, when you said I challenged the bears? Are you able or willing to say I challenged the bears today, or not so much?
No, I would say the following. It's totally, the confidence is not the same, because that came after a major bear market. This is coming off a minor correction. So this is more of a trading signal, because if the market, as I said, if the market in October 22nd of 2022, I would say there's no way the market's going to crash from here. Impossible. When I look at what I call is my technical indicators, there was too many bullish indicators to tell you that the market could make a top here. And we hadn't been at it. We're coming off a low. Now we're at an all-time high in the SP 500 with major divergences. I'm not arguing. Major divergences versus some other broad indexes. So, maybe you only get to the minimum, which is another 6.82%. It's different than it was then.
Okay.
But if somebody asks you where to be positioned, the answer is to be positioned long now, not short, not out of the market, because you just had a correction of, was it 8, 9, 10%, 11% in the Nasdaq, 8% in the S&P, and we got buy signals. You got to be long. But for me to say it's gonna last for a couple of years into a major bull move, I can't say that at a point. But the way to be positioned clearly is to be positioned long. No question about it. I'm going to get to the how we deal with our mechanical models a little bit later. I just want to tell you what. So for institutional clients, we're short into the March 30 lows. We into the July 29th low. We were long. We're 100% long. We're not leveraged long, and we're watching to see whether the market's possibly going to set a short-term top this week, because we have reasons to think that there may be some of the gaps may have been exhaustive, and maybe we'll at least test the lows. It's an outside chance we'll break the lows, but that's really an outside chance that we break the lows. But I have to say, there's still a possibility. I mean, maybe there's something out there that we don't recognize. You see, now just a point to note, we made a new all-time high on Friday in the S&P, but only 21 stocks generated an all-time high on that day, which is sort of low end of the range of when the S&P had an all-time high. I think you saw 16 new highs on March 24th, 2000. I think it was March 10th, 2000, the day of the peak, and before the dot-com bubble peak. And then you saw 16 new highs in the S&P. Now you saw 21 new highs, which is a very low reading on a day that the S&P is at a new all-time high, especially when the S&P small unweighted index just made an all-time high a couple of days earlier. Let me show you this chart. This is pretty fascinating. This is the S&P 500 equal weight index. You'll notice this didn't bottom on July 29th. It bottomed July 23rd. Made a new all-time. Let me see. It made a new all-time intraday high on August 5th, and it didn't. This hasn't been in a no correction. It really was basically straight up since the March lows.
Mm-hmm.
So that's a very positive development. But you'd think you'd see more new all-time highs in the S&P. If the S&P 1500, I'm sorry, if the S&P unweighted index is at a new all-time high, you'd think you'd see more than 20 new highs as the S&P is making a new high. That did not happen. Let me just check on a closing basis. It's at a new all-time high right now, August 10th. If the S&P equal weighted would close right now, it'd be at an all-time high.
Milton, okay. I got a quick question for you. So you saw things to make you bullish about the July 29th low.
Yes.
But you have written how you haven't really seen a lot of buy signals, like firm buy signals, and you said that you don't see evidence of the action is breakaway. So what precisely are you waiting to see before you'll see these buy signals, if you see them, which I'm not saying you will?
First of all, theoretically, we don't need any new buy signals because the buy signals that are generated in April project out to a year. We gave you where the historical projections go. So you don't need any new buy signals. And we'd say what we saw into the July 29th low was just a minor correction. Let's face it, the S&P only declined 4.5%, and it bottomed in June. It didn't bottom in July, so it's just a minor correction, which is a random event to have a minor correction within a bull move. So the fact that we have all these signals in April is enough of a reason to be bullish here. However, with the fact that the leading index, which was the Nasdaq, the NDX 100, Nasdaq 100, as well as the Philadelphia semiconductor, the fact that they really declined sharply gives us reason to be a little bit cautious. Maybe something's different this time. But again, I don't want to be forced into a bearish posture.
I'm not.
The likely scenario was bullish. I don't need any new buy signals. The action off the lows in July was very, very strong, but the thing is lacking. First is the divergences, and when I tested the history of these signals, they're not necessarily bullish. I tested what took place off the July lows based on history, and they don't necessarily give you a buy signal. So
tell me about that.
Well, I'll try to show you.
Is this when you said that it's action that looked like May 2000 or something?
Here, let me show you this one. This took place on August 5th, 2026. This is a recent signal. It's not in my model. You'll see why in a minute. But it's a recent signal that took place on August 5th. Okay? What happened is the Nasdaq's 5-day gain was its greatest of the year. Earlier we talked about 10-day gains, right? Mm-hmm. Off the March lows, the 10-day gains were the greatest in 2 years. This is Nasdaq's 5-day gain was greatest in 1 year into August 5th. The S&P 5-day gain was the greatest in 1 year into August 5th. NDX gained over 8% over a 5-day period, and the Philadelphia semiconductor gained 14% over 5 days. You see? So let's see the history. It signaled on November 2nd, 87. It was at a retracement rally high. The market declined. The SP declined 12% to test the low. You see, that's not a reason. So maybe long term it's bullish, but no reason it won't pull back. It signaled on May 2nd, 1997. It's very similar to us. This is a case where it's very similar to our situation. Let me show you. This situation here was just after a minor correction in the S&P, similar to what we had now. So that in that instance, it's very similar to what we saw now. In this case, the market gained 20% in 109 days. This is a double signal, May 2nd and May 5th, 97. August 15th, 1998. October 5th, again, a major bull signal. But here, a signal in 2008 during the financial crisis, the SP declined another 24%. So again, telling you that we called all the signals that aren't perfect.
Yeah.
One of the signals we tell our clients to buy based on. But we put in
Milton, that signal happened during one of the biggest bear markets and financial crises in history, which clearly we're not in now. I mean, it could start tomorrow, of course,
Well,
but
guess what?
what?
Clearly, we're not in it now. But if you read the headlines and you read what other people are saying, not me, they're talking about a major crisis in private credit, which is still underlying. So people aren't aware of it yet, or even banks aren't aware of it yet. But it's quite possible that there's
Yes.
maybe financial crisis setting. I mean, I'm not going to predict it. I don't think it's happening. But we're not in a situation now where you can say there's no financial crisis developing. We haven't liquefied our economy. After a Great Depression, after a Great Recession, you could say it's highly unlikely that there will be another financial crisis taking place because everything has been liquefied. But now the reality is, besides margin debt in the stock market, there's margin all over the place. I mean, look how many commercial real estate buildings are being held up, just on margin, on debt, with no real equity. You see, so I don't want to. But what I say is the following: had I not done my work and tracked every market bottom since 1957, I would not have known that on November 28th, 2008, the same bullish stuff took place, yet the market went down another 24%. You see, now that I know it, and now that I know our perfect signals, I would not act as a signal. I said it to my clients. This is a report we sent to bullish 5-day factors. I sent that on August 6th. I sent to my clients. But despite the generally favorable historical record of these combined indicators, we do not view this as a high probability tradable signal. See, we were long, but I can't consider this a high probability signal. I just can't, because a high probability signals show much better returns than this one. Even though the median return after the signal in the past was 37% within a year.
I got you.
But you had pullbacks of 24% and 12%. So you could take it as a bull signal and say Milton's out of his mind.
No.
But I'm not.
I don't think you're out of your mind. Milton, have you had any signals? Milton, have you had any sell signals since the sell signals you had in December that we talked about last time you were on?
Yeah. We had these signals, and we had the signs of a top in June, which ultimately proved to be a top in the semiconductor index and the Nasdaq 100 and the Nasdaq, but it didn't really affect the broad market, the S&P. But we saw, we showed you these. There were cycle highs. There was also divergences. There were exhaustion gaps into the highs. The stocks had a double island reversal into its high. So we saw that, but the buy signal, the oversold panic selling into July 29th offset that, at least for the short term. Maybe even for the intermediate term, especially considering I have buy signals in April that's still in effect. I can't really pound the table and say things. And again, if someone's going to tell me that the market's going to crash in the next few months, I would say I can't prove him wrong. I say give me the evidence, but I can't prove him wrong. I say it's too early. I don't have the evidence. The evidence will come later on if it's going to happen. But at this point, I'd say anything on the negative side is possible. We're a totally over-leveraged economy. The next move for the Fed is going to be tightening. You already see the 2-year bond is tightening. It's rates are multi-year highs. You're seeing the 30-year bond at the highest levels in also in decades, I think. So you're seeing and you're seeing, as you know, private credit is really collapsing in a way. I mean, this is just a secret. The banks aren't talking about it, but it seems obvious.
So on private credit, I think that the peak of the private credit doom narrative so far was probably in January or February. So a lot of private credit firms have reported that their second quarter, and it's actually a little bit of an improvement. I'm not saying that that's super predictive, but Milton, talking about the Fed, the 2-year rate did tighten, be pricing in higher, more interest rate hikes from the Fed because the price of oil went up, and now we have this new Fed chair who could be hawkish, and he says he's going to tame inflation. But my read is actually he's not that hawkish, and I think the long end of the bond yield, the 30-year, the 10-year, is kind of sniffing that out. What's your case there on the Fed?
Well, first of all, I don't know how to define hawkish or not hawkish. I think in order to get inflation down, you're going to have to rein in the money supply and raise rates somewhat. So I think he's going to be forced to raise rates. Whether it's hawkish or not, I don't know. But I think he'll be forced to raise rates. Most likely, he'll be forced to do quantitative tightening because he's a monetarist.
Yes.
And he realizes that inflation. Now, oil and inflation have zero correlation. It's a big mistake to suggest that oil prices have anything to do with inflation. Inflation is a monetary phenomenon. If oil prices go up and there's no money to cover it, there's going to have to be decreased prices and other assets, other things people buy. It's just the way it is. If I have $100 in my pocket and I have to spend I used to spend $20 in oil, and now I'm spending $60 in oil. I will have to spend less on other things. So it's just a false thing to suggest that oil prices have anything to do with inflation. It's really a monetary policy that has to do with inflation.
So you're talking about long-term inflation. So you're basically saying inflation is not PCE or CPI, what the Fed measures or what the BLS measures. So okay, we can move on, but just wanted to
Let's move on to that. If everything else being equal, if an oil shock causes the price of oil to go up, something else will have to go down. Now maybe that's not inflationary at all. Maybe what goes down is the economy or other or wages or something. But unless you accommodate higher prices, always higher prices, not inflation. Okay, this is all theoretical thing, but to me it seems pretty clear. You could argue at least it's very little to do with picking stocks, so that's fine. Anyway, okay, here's what I talk about. We spoke about the divergences. We spoke about this already. This was my report on August 7th. Okay, let's get to the next thing because I want to show you something pretty fascinating. Okay, I think we pretty much covered everything that's relevant to the current market, right?
In stocks, yeah.
In stocks, okay.
So Milton, a lot of these very advanced signals we're talking about, obviously that's the work you do for your institutional clients. You have a retail product, Milton Berg Edge, that is far, far more simple. Tell us about that model, as well as the results that you've kind of seen and the philosophy behind it.
Yes, okay, this is the story. As I said, I've been in the market for quite a number of years, 50 years or so or more. I've spent my time. Initially, I was a pure fundamentalist, Grabe and Dodd, but eventually I spent my time trying to analyze markets, build models on markets, and I realized that it's almost impossible to call a precise top. But we were very, very good in calling precise bottoms or near precise bottoms, okay, within days of a market low. So this slide illustrates if someone had $10,000 to invest on March 21st, 1957, and he invested in the market. He never got out at the top. He waited for the market to decline 8% and then got out. And then waited for a buy signal from our models. That $10,000 would have grown to $1,152,076,996.13, 18.4% per annum. This is including the reinvestment of dividends. Why? Because we're very, very good in picking market bottoms, but we really could not model market tops. If we try to market top, we're going to miss. We're going to get out of the market one day and the market's going to rally another 50% because it's almost impossible to consistently pick market tops. So what we decided is to create for retail investors a system where they invest in the S&P 500 on a total return basis, either the SPY or the VOOs where they're getting dividends, and they hold on to it until the market declines some 8% or so, which is something we talk about. And then they only get in when they get a buy signal. This would have grown to $1,152,000,000 over the period, 18.4% per annum, which actually outperforms most hedge funds and most great investors over the period. Now,
drastically, yeah.
Drastically. This shows the history of all the buys and all the sells. Basically shows you 18.4% per annum. The long S&P trades, 91% were profitable. And of course, the T-bill trades are 100% profitable. When you get out of the S&P, get into T-bills. And 81% of the time you're in the market, and about 19.9% of the time you're in T-bills over this long-term period. Now, what does this show you? This shows the actual gains, actual gains per trade. And I want to show you here. This shows the year-over-year returns based on this model. And I highlighted the years that we were down. So, for example, in 1973, the model lost 0.21%, but the S&P was down 14.85%. You see.
Mm-hmm.
In 1994, the model lost 0.88%, but the S&P was up 1.23%, pretty much matched the S&P. In year 2000, we're down 5.57%, S&P down 9%. 2008, we're down 1.35%, S&P down 36.99%. That's on the down years. So basically, what I'm just pointing out is that on a year-over-year basis, there's very little volatility. If you look where the S&P was down, it's another story. Like, for example, let's say right here, S&P down 11% in 2001. We're up 19.93%. You see, S&P is down 26% in 1974, and we're up 20.10%.
So Milton, so it's basically, so some of these programs are like, oh well, we'll increase your Sharpe ratio, and so in terms of return, your returns are lower, but our volatility is down even more. So like your risk adjusted returns are even higher. You're actually saying the returns are higher. But Milton, I will say, so all these signals you've had for so long, but these it is obviously a back test thing. Like Milton Berg Edge didn't exist in 1973.
Yeah, well, the term back test doesn't apply. I'll tell you why. When people use the term back test, they're talking about finding various indicators or market or momentum measures or crossing of moving averages or rates of change that they have to test over the years to see which ones work and which ones don't work, right? That's basically what they're doing. We just looked at market bottoms and see what took place over the years when the market bottomed. We're looking for rarities, statistical rarities, because my theory is that generally on a daily basis, market movements are random. What happens today is market's down 7.9 points, the S&P is down 8 points currently. On the news tonight, CME is going to tell you why it's down. Totally ridiculous. Daily moves in the market are random. However, at turning points, action is not random. At turning points, momentum is not random. Rates of change is not random. The information you see is not random. It occurs very, very rarely, and it tips you off that a change is going to take place. So it's not a question of back testing, but I'll show you the signals in a minute, get an idea. So I like the term back test because that back test implies you're sort of trying to find various convoluted combinations, and you're going to see it works. And then you do forward tests as well. Every signal of ours is a forward test. In other words, when I spoke to you in 2003, saying that you're buy, that was a forward test. I was right because the signal that worked in the past worked in the future. When I spoke to you in April of 2025, after that decline, and I said buy, that's a forward test because I was using historical indicator to and what happened in April of this year is also a forward test. When I give my clients, but it's a forward test based on the rarity of data, and the theory is when this kind of rarity of data is suggestive of usually of panic selling, of major reversals, and so on and so forth. So your question is good. I don't know if my answer is as good as your question, but I'm trying to explain. The term backtest has very negative connotations because backtests, as they say, never work. Backtests never work because backtests, people just change a parameter by a certain amount and change a moving average a certain amount just to get it to fit. This is not data fitting. This is looking at bottoms and seeing which data occurred at those bottoms. And did it occur at any other bottoms? And if it did, then those were real market bottoms, and it didn't occur at another, it's a signal. Let me just continue the number of trades. On average, is one round trip trade every 1.25 years for the retail. In other words, the kind of retail investor we're looking for is not a person who has to watch the screen every day and see what the market's doing. The average trade, you go long, and it's T-bills every 1.25 years. For example, in 2025, you had one trade, which occurred on April 4th, 2025. We got out in March of this year. We got in April 10th. One trade for this year as well, you see. Average one round-trip trade per year. Now, I actually listed every single buy date in history, just to give you some idea. October 21st, 57, which is one day before a low. November 1st, 1960. These are all our buy signals, you see.
Does the model get back in when you have any buy signal whatsoever, or there has to be a lot of...
The retail model goes in at the first buy signal.
First buy signal, okay.
But for institutional model, we're going to constantly get confirming signals we're going to talk about. Retailers need confirming signals because they're going to stick with the market until the market declines, say 8% or so. So this is what we did for the retail. And as I show you, these signals aren't... Institution doesn't have this signal. Institution only has perfect signals. So in other words, while the retail account will get in right here and lose, we call it even further to for our institutional to have only perfect signals. But for institutions, we're recommending. Let me get to that in a moment. Let me first finish retail. Any more? Let's go back here. I mean,
and your retail model is long right now, 100% long right now.
Yeah. Let me show you. something right now. Look. I don't know if this might not be updated to currently. It might not.
Yeah, let's go 2026. Yeah.
Stocks 10-day rate of change in the Philadelphia Semiconductor Index is 20% or greater, and the S&P is at a 2-year high. Just simple that. Okay.
That sounds pretty bullish to me.
Well, let's look. It is bullish, but I would. This is it's the last leg up in 87, gained 28%. Okay, it's multiple. See, in 1997 after minor correction, and right here. It gained it's only updated on June 12th. It gained significantly more, about 11% since then. So this is a signal, but this is not, we're already bullish. This is not an important signal. We had so many signals before that, so I didn't really show it today in the presentation. That's the last signal we got.
That is interesting, Milton. Now, can we, among gold, silver, and oil, what is your most interesting things you have to say? So you can kind of choose the topic. I
Well,
know last time you came on, you said you sold your gold and silver the day of the high,
last time
or
I got on to you, we talked about gold. I'm going to talk about gold now because I prepared to speak about gold just to show
yeah,
just to show what happened post.
that was a
If
good
you
call.
call on Twitter, when I said I sold, no one believed me. Remember, they said I had to show my check.
Yeah, I believe you,
You
Milton.
believe me, but you remember all these guys say it's ridiculous. No one sells
Yeah,
at the top, right? We sold on January 29th. I tell you, woke up in the middle of the night. I saw what's going on in the futures market of gold. I told my wife, we got to sell our gold. This is the top, and we sold. I didn't get the exact top. By the time I got to the dealer during the day, the market was already lower. But this is our gold sale. Next.
I never doubted you, Milton.
Next, we showed this last time. You say people will say now's the time to buy gold. This is gold in various currencies, GDP weighted currencies. We said, maybe this was the time to buy gold here, or maybe this was the time to buy gold here. But to suggest that the great time to buy gold was right here made absolutely no sense. Just looking at a chart made no sense.
Yeah.
And then I said, if we're really headed for hyperinflation or high inflation, why would gold? This is the January reading. Why would gold relative to crude be so high? Crude also moves with inflation. We discussed this earlier, right? Crude moves with inflation. So why would gold be at that extreme to crude?
Yep, you divided gold by soybeans too, and you
I did
said,
soybeans
yep,
too. Then we showed this is gold again, gold divided by crude. Okay. Then we show gold according to relative to housing. I mean, housing is also moves with inflation, right?
yep.
So why would gold be at the second highest level ever since the
Gold
peak?
relative when we recorded in early February, gold relative to literally every other commodity on the planet Earth
Right,
was
right,
very high.
right. Anyway, my point now is that's not a trading signal.
Yeah.
When that happens, it's a long-term signal. For example, this peak in gold in 1980 relative to inflation led to a 20-year bear market in gold. 20 years of bear, even though inflation doubled over the period, it led to a 20-year bear market. I'm not saying a 20-year bear market. I don't believe we saw a trading top in gold. I believe we saw a long-term top in gold. Um, and this is gold to CPI. Okay, silver to CPI silver was not at the same extreme, but silver has been a dog really relative to gold for decades already. So
Yeah.
silver is trading more like a weak commodity than a strong commodity like that gold trades like. So that's silver. Let me see. This is someone on the internet. I don't believe it, but I'm going to show what he's trying. He's trying to say, going back to 1993, a long-term cup and handle that the pullback is a pullback within a bull market, and it's headed up to, I think he's talking about like $3,000 for silver. This is silver. I don't buy these charts. To me, this is showing an extended market, not a cup and handle. Cup and handles make sense with stocks, with companies that have retained earnings. Silver doesn't have any retained earnings. This is a long-term chart showing that it was at an extreme. He might be right. It's a back test within a cup and handle chart. I think it was a long-term top, and we're not going to be heading much higher. That's my feeling. This is the report we wrote on January 30th. I don't know if I showed it to you last time.
You
We were
did. You did.
together,
You did.
right? We
You
wrote
you nailed it.
right.
Literally the day of the top.
Let me see what we have over here. This is now here's silver. Here it is. See this upside gap? I was tricked by this gap. I went long on this gap, thinking it's impulsive. We were out of gold. We traded long here. We got out here, believe it or not, and I got long here,
Mm-hmm.
and I was wrong because this gap, 3 days after the low, turned out to be an exhaustive gap into a retracing rally within a bear market. You see, so I was very wrong about that. I'm just showing you the chart. We're upside gap and spot on June 15th, and this is the low. It's basing. Let's see. There's another chart of silver.
What about now? What about now in
I'm
silver?
going to tell you now. We're positioned long on the upside gap. I write it down, but we were wrong. Let me tell you what I feel now, and you'll see in a minute. This is turning out the low. We felt it's bullish. We got out of gold and silver and GDX just a few days ago, right before the big up move we had the last few days. And maybe we'll get back in. Since we have what I call the Montgomery cycles taking place this week, I think it's likely or more than probable that gold and silver and GDX peak again this week and trade back down to the lows. I think we're in a long-term bear market in gold and silver. I think within a bear market, you're going to have very good rallies. Maybe we're in one of those rallies, but I thought I'd play it. I got out. I'm probably not playing it now. But if you look at a long-term history of gold and silver chart, even during the major bear markets, of course, they have strong up moves within the bear market. So I say we're in a bear market in gold. I don't think we make new highs, but I think we will have retracement rallies. We had a nice rally up here. I mean, a significant percentage rally in gold. Maybe it was like 30%. Here's gold right now. We got long here and it was wrong. It was exhaustive, as you can see. Normally it's impulsive after a low. Came down close. We got long again, but we got out. We missed these 3 days of rally, but now we're in a period where you can get a retracement rally top, and we think that's more than random to get it. So we're out now. Let's see what happens in the next 3 days. We're cautious over the next 3 days in all markets. We think the KOSPI might generate might be heading down to a retracement low, a test of the low. So too with the stocks, and we think it's possible the SP 500 also just making a short-term topper and heading back to the lows. We're not pounding the table at anything at this point.
But Milton, if the KOSPI Milton, if the KOSPI Nasdaq or semiconductor index go through, i.e., they go below the July 29th lows, is that going to be bearish?
If the KOSPI goes below this low, I'll show you. I wrote this to my clients. If the KOSPI goes below this low right here, this low, intraday low, not the closing low.
Yeah,
that's very, very, very bearish, because in a crash, that should not happen. If it's crashed, it should test it, but not get below it. I mean, let's look at the KOSPI over those 3 days. On a 3-day period, KOSPI is down 22.68%. I mean, that's a crash. And crash lows are tested, but crash lows aren't violated. And the test is on a closing basis, you see. It could make a lower low. And that would be very, very normal for it to close. Be very normal for the KOSPI to close below this low that you saw on July 30th, but it would be very, very unlikely for it to trade below the intraday low of July 29th.
So how extreme is the difference between the intraday low and the low?
I'll give you that right away. Let's put it this way: from the current price of the KOSPI, the intraday low is 19% below the current price. Okay.
Mm-hmm.
From the closing low, which was the next day, the current price is 12%.
Okay.
Given the 12% to 19% decline.
Yeah.
Okay. So anything between 12 and 19% is normal. Anything more than 19% suggests something different, and this is going to go much lower.
So if KOSPI sells off 13% from here as we record the afternoon of August 10th, that's fine. But if it sells off more than 19%, Milton's getting very worried.
Yes, exactly.
Okay.
We're long the KOSPI. Let's say we're 5% long KOSPI, which is just we couldn't avoid it. You had a major crash into a cycle date, panic selling. Margin calls all over the place. Look, the market was liquefied. That's what you want to see. A good market is one in which non-liquidity becomes liquidity. And that's what happened in that market. Tops occur when there's low liquidity. Bottoms occur in conjunction with excess liquidity.
Final question about the long bond. The 30-year Treasury yield is now at the highest level since, I believe, 2007. So on a technical basis, it is not looking amazingly healthy, to put it mildly.
I happen to think the following. I have a strong view on bonds, actually.
Yeah.
Very strong view on bonds, which nobody shares with me. Let me go to a long-term. Let me get a long-term chart of bonds, okay? Let's go back to 1980. You see your bonds are now 5.424.
Yeah.
You had decades your long yield was greater. I think your long bonds are way expensive, way cheap. The yields are very cheap. Bonds are expensive. I think that the yields should easily go up to 6 to 6.5% to 7 to 8% as a normal fluctuation over the long term in bonds. People are acting the bonds are very oversold because it's at 5.42%. Well, let's look at the chart. Let's look at the chart. Simple look at the chart. Look at this. From 1980 until basically until 2002, bonds were always above current yields, right?
Yes.
There's no reason it shouldn't get above those yields. I think this is normal market. This is normal bond action. This wasn't based on any inflation at all.
Yeah. And Milton, Milton, when I entered the business in 2019, because of the trend line and then the trend line that happened in March 2020 with the yields collapsing, literally people would draw a trend line implying that like yields would go negative, like as if the 10-year would go to negative 3%, like as if that was their base case. So it just goes to show that the trend line has been broken. And I was just literally, Milton, this morning thinking, to use your rule of what can I say with, nothing's telling me that this can't happen. Like the spread between, the yield curve between 2s and 10s can get as wide as like 300 basis points. So nothing says that, with the, even with the, if the Fed cuts rates to 3%, that the 10-year would go to 6%.
Yeah. Okay. I have no problem with the 10-year, 30-year going higher. I don't even think it's negative. That itself is not negative for the stock market. It was negative for the stock market if there's tightening, if there's liquidity squeezes, if there's bankruptcies.
Yeah.
But I think it's pretty normal for bonds. A 30. I mean, what? I wouldn't buy a 30-year bond except to trade. I wouldn't buy it to hold at 5.24%, knowing the history of the United States inflation. Why would I? And I pay, especially in a taxable account. Why would I buy a bond? It's only 5%. It makes no sense. So, if it's 6, 7, 8%, at least you're earning something. So I'm not, I think I think the Federal Reserve was going crazy over these years, allowing bonds to get to, at its low, the 30-year was at 0.69%. And that's crazy. I think it's letting, the bond market is taking it back to normal. And normal is more like, 6, 7, 8%. This is my view.
I got it. Well, should we leave it there, Milton?
Thank you. This was exhilarating. I went through a lot of stuff here.
Milton, thank you so much. People can find you on X at Berg Milton. Your retail service is Milton Berg Edge, miltonbergedge.com. And institutional clients can find you at miltonberg.com, not miltonbergedge.com.
Correct.
Thank you. Just close the door.